Once again, this is Prince Dykes here, the Royal Financial Investment Group, coming to you guys live today. Pretty much today's video is going to be what is a straddle. But before we jump into that, don't forget to like, strive, to comment, share, all of the good stuff. Leave me some comments. Let me know if it was a good video. Let me know if it's a horrible video. Give me a thumbs up, thumbs down, feedback. Tell me how I can get better, all of the good stuff. So let's get straight into the video because I don't have a lot of time, and I definitely know you guys don't have a lot of time. So let's jump straight into it. What is a straddle? A straddle is an options trading strategy. And what it does is that you sit on both sides of an options chain. So I have a video that's called that tells you how to purchase an option. But I'm going to tell you, for a prime example. So, you have a call side, which if you believe a stock is going to go higher. Then you have the put side, if you believe the stock is going to go lower. What a straddle does is you're on both sides of the market. You buy a you buy a call and you buy a put, and you anticipate a big move in you predict a big move in a company's stock, a company's underlying stock. So, for example, earnings come out. Today the market is open and it's live. Netflix just released its earnings, right? And as always, Netflix made a huge move, like it always does. It made a huge move on the upside. As of right now, Netflix is up 16%, right? So Netflix is up 16%, right? So, a huge move came. So if you straddled it, one side is going to lose and one side is going to win. What a straddle does is that it limits your profits, but it also minimizes your losses. You're not going to make a whole lot or as much as you could have if you was on one side, but you're not going to lose a whole lot. For example, had you placed a put on Netflix, you pretty much would have lost everything that you put into it. Had you brought a call on Netflix, you'd have been a very happy person because you'd have made 200, 300, 400% or whatever. But if you'd have brought a put, you would have lost everything. So some people say, hey, I don't know if a stock is going to go up, go down. I don't know. So I'm going to put on the straddle. And what a straddle does is one side will lose, one side will win. But usually you make a straddle if you think that, one side would outweigh the other one. For prime example, let's look at Netflix. We're going to go to the options chain. So as we know, Netflix is going up. Let me make sure. Go back to snapshot. So as of yesterday, it closed at $475, right? So we're going to look at it. Let's say if you brought the April 24th chain, and like we said, it closed at $475. So let's say the day before, you're like, man, I don't know which way this stock is going to go. So I'm just going to buy a straddle. So yesterday, 475 is where it was at yesterday. So if you look at it today, the put side has lost $24.58. But the call side has made $54.08. So if you subtract the two, roughly that's about a $20 difference per share. And $20 per share times 100 is, I got 200, right? So you'd have made $200 on a straddle. So if you'd have got on both sides, if you had brought a call, you brought a put. Your put would have lost $24.58, but your call would have made $54.08. So now that you know what a straddle is, and now that you know how straddle can be profitable, and I gave you a prime example of Netflix, which just released its earnings, so you say, hey, how can I purchase one? So you go up here to trade, and you go to spreads, right? Spreads. Trade, you go to spreads. My computer's been a little slow here, but there it is. So we're going to type in Netflix, NFLX. So you got, okay, I'm going to go to Netflix. And what you're going to do, you're going to buy open. Let's say you're going to buy one contract. And what you do with a straddle is you buy at the money. And I will go back and I will show you that. And you buy a call. So at the money means where is this trading at right now? So April 24th, strike price, $5.55. That is at the money. Then you're going to buy open. You're going to place one. You're going to buy a put. You brought a call on one side. You're going to buy a put on the other side. Same exact expiration date. Exact same strike price. 55. So you brought a call and you're going to buy a put, right? You brought a call and you brought a put and you buy at the money. Then you go down here, let's say you're going to buy that market, or you can put in a set price and you can boom. Just that quick, you can go ahead and purchase a straddle, and that's called a straddle. So we're going to go back. We're going to take a step back. And what does at the money mean? At the money means where the stock is trading at currently. So I'm going to type in 55, 55, 5, because that's kind of where the stock is trading at now. So you see this right here. You see it says 50. The strike price is in the money on the call side. It's right where the stock is trading at. So here's the call side. Here's the put side. So you're going to want to buy a put right here at 55, and you want to buy a call right here at 55. And that's how you sell on the straddle. And if you'd have done this the day before, then you can see how you could have made a profit. All right. Well, I hope that helps. Don't forget to like, subscribe, comment, all the good stuff. And as always, I'm out. Be safe.